Good morning. It's great to see everybody. Welcome to the TokenizeThis conference, and we're going to kick off with a fun little panel. I'm Colin Cunningham. I lead tokenization at Chainlink. And you know what? Rather than talk about each one of you, just give a quick intro, and then we'll get right into it.
Hey guys, I'm Krupetsky. I lead institutional and capital markets business development at Avalabs. Avalabs is a software company building infrastructure and tooling to really drive forward the growth and adoption of the Avalanche blockchain.
Good morning, everyone. I'm Ducoff. I'm head of institutional growth at the Solana Foundation.
Hi, everyone. I'm Rob Durscki. I lead the tokenization and regulated assets projects out of Stellar Development Foundation, and we're the foundation behind the Stellar blockchain. Nice to be here.
I'm Brad Chase. I'm Vice President of Engineering at Ripple. I lead our RippleX team, which is contributions to the open source XRP ledger.
Cool. All right, so we're talking blockchain activity and tokenized assets at today's panel. Just to maybe set the scene, right? When we talk about tokenization, what we're really talking about is how these traditional financial assets from the real world, how do they move on chain? How do we enable, bring utility to them? And then how do they flourish and kind of proliferate? The way I kind of think about it is that we've got these different layers, right? So we have these market participants at the top that want to participate. We have different service providers, right, along the way that kind of support those market participants. And then we have this really important infrastructure layer, right? And I think our panelists today will hopefully give us some insight into how we think about different blockchains, how they're used, how they collaborate, how they work together to build a tokenized asset or a real-world asset economy on chain that hopefully provides some benefits from the way the world is structured today around traditional financial instruments. But let's start here. This isn't the first time we've talked about tokenization. We've talked about it for many years now, right? Some of you have been at some of these shops for quite some time. Morgan, let's start with you. Just help us think about historically this time. Why is it different? Is it different? If it's different, why is it different? Just give us some insight into where we've been, and then I'd love to hear from some of the other panelists, right? How this time feels relative to other tokenization start and stops in the past.
Sure. So I think, like you said, tokenization is not a new concept. It's been around for a while. It kind of reemerged as a trend over the past 2 years, I'd say. I think at a high level, quote unquote, this time is different for a few reasons. I think this time around you have much more kind of institutional and enterprise grade infrastructure in place. There's definitely still like areas that we need to improve upon, but at a high level, it's definitely kind of greater. In addition, I would say we saw from a macroeconomic perspective, rates in the real world going up, and therefore the value prop for pure on-chain DeFi based on like self-referential tokens going down. And so you saw a lot of kind of cash flowing out from on-chain to off-chain. And so it really kind of presented a need to bring real yield or real world assets on chain, which is a lot of the reason why we're seeing a lot of kind of tokenized T-bills, which I'm sure we'll talk about. In addition, I'd say the advent of DeFi this time around versus last time was not a thing. And so the advent of DeFi, I think, really demonstrated that there is greater utility and capabilities that could be applied to tokenized assets beyond just issuance, trading, and settling, right? There's greater utility as it relates to potentially pledging as collateral and the composability and all the stuff that DeFi kind of brings with it. And then the last big thing that I would say is this time around, you're seeing major, Wall Street firm executives touting the future as tokenization and not just talking about it, but actually doing stuff in the space in production. And so I think between all those factors, they've kind of really come together to, push this space forward and, looking forward to kind of what's next.
I have a quick thought about that. I think on top of what was raised here, we reached the stage where regulations and traditional financial institutions are in a much more comfortable position to start building stuff. And I don't think we're at all where we want to be, but much better than we were before. So I will take this much more of an opportunity to say, wherever we reach that stage, we need to expand that to other geographies, incentivizing regulators and traditional financial institutions. But I think the answer to the question is, why is it different now than it was in 2016, 17, when all the top consulting firms were saying tokenize is the future, insurance, banks, whatever, and nothing happened, was because there was a complete lack of regulatory guidance, and traditional financial institutions like, I'm not touching that at all, where now they're experimenting, building with some regulatory comfort. But I think that's what we need to push for, is more regulatory clarity. Therefore, financial institutions will adopt more, will try more. And to Morgan's point, I think the, let's say, AAA infrastructure providers being out there to help those traditional institutions to build. But honestly, I think if the regulation is clear, they will either build it themselves or use trusted partners. But that, I think, what really changes this moment versus 5 years ago.
Yeah, I'll pile on a little bit. So just couch that in Ripple's experience. So Ripple's been around for over a decade. I've been at Ripple for almost 8 years now. Very much true. Like we've seen this story play out a couple times. And for me, what's different is very similar to what Rob said. Like really 10 years ago, Ripple's original strategy was to go to banks to get them to issue fiat-backed. We called them IUs at the time. You call them stable coins today. And everyone said, no, we're not touching this yet. We don't know what this is. And so I think in addition to the regulatory aspect, there's also this track record of resiliency. This technology's been around for 10 years, plus years. We've seen Bitcoin go through these cycles, Ethereum, XRP, all these chains. Like, I think there's a confidence there that is enabling institutions to lean in, that coupled with the macroeconomic conditions, coupled with regulatory clarity, coupled with a better infrastructure, I think it is, like all these ingredients are kind of that activation energy that we're kind of hitting now, where you're seeing real world use cases emerging.
The last thing I'd add is I think the on-chain economy has grown with the technology, so has now the dollars. I think 5-6 years ago, a lot of folks were holding tokens in centralized exchanges or self-custody and not doing a lot with those tokens. Now those tokens are being used in the economies on the various blockchains. So for example, Solana had $1.5 trillion of stablecoin value transfer last month in March. And when you see those types of numbers, it kind of forces large enterprises to think about how to engage with those economies.
So let's go to this idea of production, right? We're getting more regulatory clarity, right? We're seeing new use cases. We're seeing utility unlocked. I'm sure we'd all love to know what you all have in the pipeline within your various ecosystems, but let's kind of talk about what's in production, right? What's live? What can we talk about from a use case perspective for partners within your ecosystem? And Rob, maybe we'll start with you here, is talk to us a little bit, if this time is a little different because there's more clarity, right? What's the utility? What are the use cases that people are looking to Stellar or any of the chains here as they think about tokenized assets on-chain?
No, happy to. And again, I think we're really together in this here in different chains, but very similar use cases. And I think ultimately that the goal is to try to get more financial institutions to try distributed ledger in general, right? Speaking a bit about the data and the information I have from the Stellar ecosystem, I try to simplify how we kind of bucket the tokenization use cases in payment assets and investment assets, right? So we're seeing both of them growing, and then they can be broken down into many types of assets, but both use cases are growing fast, and now more the investment side, because stable coins and others have been around for a while. But I think it's the interoperability between those two that really is going to unlock the value. So what we're seeing now with partners like Franklin Templeton, WisdomTree, and others that are issuing this kind of new round of assets on chain is that they want to unlock yield, they want to unlock easy investment products and easy access to retail clients, but they also want to make it almost kind of seamless to use that as a payment tool as well. So either you're coming from USDC or other stable coins because you're on DeFi and now you want to go back to a more regulated, lower risk asset, but you also can actually use those tokenized assets as payment. So nothing prevents us here to kind of splitting the check on a dinner and I pay you guys with Franklin Templeton funds, because I can send you $20 in 3.6 seconds on Stellar, and there you go. I paid you dinner. If you forget about that, you're getting 5-6% a year on that, bill that we split. So I think there's this, positive blur between investment and payment because it's ultimately value, right? And we're unlocking the movement of value. So I know this is very philosophical, but in practical terms, that's what we're seeing happening. It's like retail wallets unlocking the usage of payments and investments almost as the same seamless experience.
I would maybe just add to that. So I totally agree, and I think what you're kind of alluding to is really from a underlying blockchain protocol perspective is really the idea of using and leveraging a shared distributed ledger as a means of value transfer, right, across whether it's payments, investments, whatever it is, where historically you have in TradFi, many different third parties and systems operating in silos and therefore requiring a lot of manual reconciliation, which obviously adds to a lot of the costs that leveraging this kind of shared distributed ledger for data and value transfer, obviously makes it a lot easier and more efficient and ultimately cheaper. In terms of what we're seeing, I think it's probably along the same lines where anecdotally I'd say a lot of the interest from a financial services perspective is really kind of in two ends of the liquidity spectrum. On the one end, we're seeing a lot of interest in the tokenization of cash and cash equivalents, so stablecoins, tokenized deposits, wholesale CBDCs, yield-bearing stablecoins, and money market funds. And to that end, a lot of the issuers, whether they're kind of large asset managers or more crypto-native startups, I think, to your point, Nick, are targeting the more kind of crypto-native audience. They're looking at kind of all of the USDC and USDT that's on chain that's not bearing any yield. So I think the go-to-market is very much focused on kind of converting some of that crypto-native holding from treasuries and DAOs to potentially yield-bearing, low-risk assets. And then on the other end, seeing a lot of interest in, I would say, the tokenization of alternative assets, so private equity, credit, real estate, and infrastructure. And the motivation, I think, there is, in the first instance, less so targeting crypto natives and more targeting kind of the growing mass affluent and accredited investor market in the US and globally, where historically they've just not had systematic access to these types of investments. So the idea is, you combine not just tokenization, but smart contracts and blockchain to really create the efficiencies and cost savings in the administrative process to make lower investment minimums economically viable for issuers, and therefore allowing these individuals to have more ready access to these types of investments. So I'd say at a high level, those are kind of what we're seeing.
I agree with what both of my colleagues here said, and the thing I would add to what Morgan said is on those longer duration assets, the private fund tokenization, it's also adding liquidity and utility to those. So today, if I'm an investor in a private fund, there's virtually nothing I can do with that. My name is on the cap table, and for 7 to 10 years, I just sit and wait until that comes back. On chain, with secondary markets, which don't really yet exist today for these assets, but will tomorrow, I think that provides liquidity and then utility. In the meantime, while I have that token, I can pledge it as collateral and borrow against it to use it for other needs that I may have today.
Mostly +1, not a lot of disagreement on this. I guess the angle I could share just from Ripple's enterprise software offerings and kind of how we're seeing tokenization trends from our customers. So one, our biggest offering is a cross-border payments product called Ripple Payments. Share DNA with Stellar in many ways, so also can send funds and settle globally in 3 seconds. Those customers now have their own customers that want to pay in stable coins, and they want to hold those stable coins. So that's kind of the simplest on and off ramp gateway for them into the space. And then last year we acquired a company now offer a custody product. HSBC is a customer, and they're now looking to tokenize. They see the benefits that their customers are getting from holding digital assets, like purely native digital assets on their behalf, and now what else can we kind of use this technology for? So same kind of trends that we're all seeing here, where they're seeing the benefits and wanting to lean into the space.
So one of the things I think a lot about when it comes to blockchains is there's probably some standalone benefits of the blockchain itself, right? And then there's these ideas of interoperability and composability, which I want to punt on for just one more question. Let's come back to just blockchains purely. We just talked about some good use cases on how the partners think about it, right? Blurring the line on payments, fractionalization to some degree, or kind of knocking down the minimums for which investors can access traditional assets, and some of the collateral utility or leverage ideas, right? When we think about just blockchains at a pure technical level, bit of a targeted question, but what's for you at an individual level, or if you want to talk your company's book, that's fine too. What's the specific thing that you think blockchains specifically make the greatest gains if you just look at a blockchain as a standalone entity, right, on behalf of some kind of traditional, let's take it from more of the institutional angle, from more of the institutional set, right, or more of the traditional TradFi set. What's the thing that the blockchain is really positioned technically to solve the best?
I think it's atomic settlement, right? To be able to have access to the cash once you trade out of a token and then be able to redeploy that immediately elsewhere. And the fungibility, right? To use it as payment or whatever else you want to use it for. So I'd say the fungibility and the settlement.
Any disagreements with that? Any other ideas around that?
Well, I don't think it's a disagreement. It's just on top of that. So I think that's very important. I think we for those who comes from banking, the idea of the messaging layer and the settlement layer being completely decoupled has been around for decades, right? When we think about SWIFT and then doing correspondent banking next day or next week settlement, that is something that in general doesn't need to exist on blockchain because you're literally submitting a fraction of a cent or a billion transaction in real time and the settlement is done at the same time. But on top of that, I would say that especially for smaller companies, and we try to help those a lot, is the fact that you don't need to necessarily sort out your own core banking ledger infrastructure versus using a shared one. So that could, put you up to speed faster on a new product or a new project. And maybe broadening that concept to bigger entities. The analogy that sometimes I use is that each central bank has been building their own highway for decades on trying to create infrastructure for their country, and blockchain kind of in parallel create a international highway. People could argue if the cars have the right plate or if they're in the right speed, but that said, if you share that ledger, we're literally being able to send stuff between entities with no additional hurdle, right? Like nothing prevents Bank A to send assets to Bank B if they're on blockchain. So I would say it's kind of go-to-market opportunity for smaller entities, and the fact that you're sharing the same ledger as you're potentially joining the same chain, or with interoperability layers that I know we're going to get there.
One thing I just add that I guess kind of the technology that enables those things to me is just the shared immutable state that a blockchain affords, where it enables us to be somewhat public infrastructure that we all share, and that lowers the barriers to entry, lowers cost to operation, and just gets these efficiencies of atomic settlement and beyond. So I'd say, like, from a technical innovation, if you take away the use cases, it's really that shared immutable state that you can reach in a decentralized manner is just, blockchain and Bitcoin, as the original was the game changer.
You really want us to disagree, don't you?
Just trying to get it cooking in here. So let's move then into kind of the interoperability or composability piece, right? Because I think that is fundamental to how we look at how this ecosystem builds, right? And in your own right, each of these blockchains have built their own ecosystems. You've built your own kind of digital economies, right, around your own blockchains, your own businesses. One thing that's popping into my head right now is maybe the difference between interoperability versus composability. And I think that might actually be an interesting, I could actually learn a little bit here, like how we differentiate those two. I think it'd be interesting to talk about that. But when we look at interoperability and we look at maybe the success or the moment that tokenization has right now, let's just talk about for a second, how important is interoperability to, if this is tokenization's moment, if this moment is different, right? How important is interoperability, and what does that mean? Let's put that in context for the audience, for whoever wants to start.
So I'll jump in. The analogy, if you think about the internet, in the 90s you had AOL, you had CompuServe, you had Prodigy, you had probably other ones I don't even know of, and they were nice. You were able to do new things and use, access stuff via your computer, but you couldn't send an email to each other necessarily. You couldn't, foster information sharing, and you ended up just having a walled garden that happened to be nicer, and there were more fun things to do in your garden. But I think, what the internet did is it took those walls down, and you started to be able to still have, pockets of specialization and places you would go to do things, but you could kind of transfer data across, you could interact, you can kind of have a portal that gave you that access. And so the same thing where there may be chains that are better for tokenizing or managing different real-world assets differently because they have different features from either security, core protocol capabilities, smart contract features, whatnot. That will continue, and that's how you innovate, right? You have specialization. But interoperability is what's the thing that's going to enable mass adoption, where I don't need to go get a new wallet for this other token, or I have to go to to a different country to be able to use these things. And that's what the industry has been able to develop over the past decade. Obviously, there's lots more to do. So when I think of interoperability, it's that type of experience where it's you're in the system and you have the fluidity to move value and transfer value within it kind of efficiently.
Maybe just to add to that, I think when the industry refers to interoperability, just to kind of distill what we're talking about, it's the idea of being able to kind of seamlessly go from network to network, from layer 1 to layer 1, or layer 2 to layer 1, or...
Is that on-chain only when we talk about interoperability?
No, and I think to your point, it's kind of integration with traditional systems or traditional rails as well. And I totally agree with what you were saying, but I also think that to a certain sense, and maybe to be a little bit spicy, I think a lot of people are looking at interoperability today as like the thing that will solve for mass adoption, whereas I think, instead a lot of kind of companies should instead be focusing on their application and their use case of what are they going to be building to enable and kind of draw the next X amount of users, frankly, without even knowing or caring that they're leveraging blockchain. And then kind of exploring like, what can interoperability kind of afford for user and user experience. So it's not interoperability just in and of itself, but it's what are the applications and use cases that we can build on chain today that are very compelling, and then kind of exploring like, what can the interoperability enable from there.
So maybe a word that describes what Morgan is talking about is abstraction. And that's one of the things that I think in the Solana ecosystem folks do particularly well is UX and making the blockchain very easy to use, and whether that be for retail or institutional. And that's from the infrastructure layer all the way up to the application layer.
And sorry, do you mind if I just...
No, please.
Because this is a dear topic to me as well. Like I've been pushing interoperability for a long time now, and I know there are great efforts with the enterprise, the Ethereum Enterprise Association, SODA, and the Interoperability Committee, the IETF, and Accenture, IBM. There's a bunch of...
Tokenized Asset Coalition.
Yeah, exactly. There's exactly RWA, and so I think all those efforts are showing the momentum. And if there was two things to me that will drive the growth of this ecosystem is regulatory clarity and interoperability. And to Morgan's point, I agree. It's not a silver bullet. As you let's say tomorrow we wake up and all the chains are talking to each other. Is that going to unlock retail usage? No, not necessarily. But I think that would unlock the courage, and I'm using a strong word here, for institutions to develop products on chain, right, and enable that retail experience. Because what I hear talking to banks, and not from one or two, many, a lot of them out of the US, is that without this feeling that, for example, something I built on Solidity will be able to be built on Rust, or something that I built on EVM will be able to be used on a non-EVM chain, I'm not even going to start playing around. Or if I don't have clarity from regulation that I can go from a permission to a permissionless chain, I'm also not going to play around. So that lack of trust, there will be a trusted interoperability layer and some sort of regulatory guidance is what preventing innovation. And therefore, no retail usage, no UX improvement, no mass adoption, right? So those two pillars, to me, should be the priority.
I mean, this is more of an ask. I don't know who all is in the crowd today, but presumably everyone here is at least curious about the blockchain, if not already building on it. But the institutions that are building today, even before all of the infrastructure is available for interoperability, abstraction, and everything else, those are the ones that are going to benefit when the regulatory light goes from red to green. And it seems very long ago because crypto years are like dog years, but it was just this January when the Bitcoin ETF was approved. Right? And I don't know where all you were that day, but I remember the days and weeks leading up to it and talking to folks, very senior, in DC and very senior at these large asset managers. Nobody knew, right? Folks had varying opinions of whether it was going to be approved or not, but it was, right? 3-2. And, now we've got multiple ETFs with $10 billion of AUM in Bitcoin, and that light turned from red to green in a day. Yes, it was 10 years in the making, but the regulatory green light for banks and asset managers for more native on-chain activity will turn from red to green too. And the folks that are building today and putting in the work even, and building some of the tooling that we all will benefit from, those are the ones who are going to benefit when that light turns green.
So just to maybe hammer home this point on interoperability before we move on. So we're talking about this ability to interconnect on-chain, right? But let's talk about for a second, because I think this takes us into our next topic. Within your different, roles, talk to us a little bit about how you think about reaching out into whether it's interoperability or composability, integrating into kind of the Web 2 tech stacks that have been built in traditional finance, right? It's been built for 20 years, right? There's billions of dollars that have been built around these Web 2 tech stacks. I think sometimes the Web 3 community gets this wrong, right? Where we just kind of think, well, we built the blockchain, they'll just come on chain. That's obviously not the case, right? So I think it'd be helpful to understand or just hear your views on what does it take to do that well, right? What does it take to really not just say, okay, we're interconnected or we're interoperable on chain? What's the effort, right? And what's needed in order, in light of some of the regulatory clarity we're getting, and hopefully we get more, how do we reach out to, how do we go through the existing technology stacks that exist to bring more of this world on chain? Like, what's the best way to do it at scale in a regulatory or kind of compliant way?
I would just add a note that I think the Web 2, Web 3 distinction might be important from a technical perspective. From a user perspective, it's useless, right? I think that what we need is a UX that works. Like, people want to send money and money get there quickly. So what we've been seeing, I think, with technologies like MPC and the new kind of cross-chain transfers is that people don't actually know if they're using a Web 2 password or some sort of encryption of their private key. And actually, I want them not to know in the sense that it should be easy to use. I think the vision we have, and our CEO, Daniel, talks that a lot, is we don't want people to know that the blockchain is behind the product, right? Like, we want that to be just another technology that makes sense to enable new financial services. If you think about, PayPal and TransferWise, they were able to disrupt the industry without Web 3, using whatever technology was available to make the products better than traditional finance. And I think blockchain should be seen as, and I don't want to downplay blockchain, but another technology that you could compose with others, including AI or biometrics or digital identity, to improve the retail experience, right? So back to my use case, if you're able to buy, like with Franklin Templeton now, $1 of a money market fund on a weekend and get daily yield, why not, right? Like, and you actually don't know there's Stellar behind it. You just know there's a nice app that you just click, create a user, and there you go. So I think the composability gets to the point of using blockchain as one more technology in your tech stack to enable better products. And interoperability is a way to get there, because I would say, unfortunately, the way that this ecosystem grew is very dispersed. Therefore, products are all over the place, right? So just to wrap up, if you think about Circle, they are being an interoperability layer. That was probably not the original plan, but through a Circle account or CCTP, you can actually now use USDC. You don't care where it's coming from or it's going to, right? Like, and in that case, if you're using dollar as a payment asset, there you go. It can come in and out any chain, right? So my point on composability is, like, is blockchain ready to get into the stack? I can see banks still using SWIFT for some countries and correspondent banks, and USDC or other stable coins for other countries. It's a combination, but the user should just see what's the faster, cheaper way to send money to Kenya or to Brazil or whatever, right?
I think, again, it comes back to a word, I can't remember who said it, courage, and then abstraction, which is folks that, large enterprises that saw the cloud early, like Salesforce was one of the first big organizations, obviously, to drive adoption within the enterprise to the cloud. Amazon, of course, too, and the folks that were fast followers there benefited greatly. Mobile, Facebook, Mark Zuckerberg, I'm sure many of you remember this, famously told his employees that one day a week they needed to, work from their phones, to figure out how to use it. Same thing here, the large global financial services firms that are building on the blockchain today, pushing themselves and the regulators to kind of embrace this technology are going to be the ones that benefit from it. And even if it's invisible, in their pipes, as long as the UX to the end user, whether it be retail or institutional, is great, then people are going to benefit from adopting that technology.
Maybe just to kind of hone in on the abstraction point, like, I think, and bringing it back to tokenization, like, I think one of the things that is maybe been like a blocker or a challenge from a mass adoption perspective is you have none of these like tokenization platforms to date have really successfully integrated with traditional distribution channels and or Web 2 channels or whatever you want to call it. Like I think the holy grail for me, I always say, is like when I'm on my Fidelity or my Schwab app and I see equities, fixed income, and now alts, and now I have access to alts and there's a certain minimum that I can kind of afford, and then eventually we'll be able to borrow against these things, so on and so forth. And I don't even know or care that it's on blockchain. But now it's kind of totally integrated with my app. There's no kind of additional platform that I need to go to. Like that is the holy grail for me. And you know, whether it's Fidelity, Schwab, Revolut, Robinhood, any of these things where there's already a kind of demand and distribution base. And I think a lot of people, a lot of like the more crypto natives in the space that are building, you know, tokenization platforms take for granted that it takes a really long time to build up a demand and distribution channel. Like it takes years. And so to the extent that they can plug into traditional RIAs or other types of things like that, I think will, you know, add a huge unlock. And what I will add to that also is historically, and maybe again why this time is different, historically, the assets that were being tokenized weren't like the best quality. So just because you tokenize something doesn't mean like people are gonna buy it, right? So over time, I think the quality of the assets that are being tokenized has and continues to improve. And so I think at one point, you know, down the line, those things will merge such that, you know, we see kind of greater adoption from a demand and distribution perspective.
One thing I'll add real quick to also zero in maybe one of the specific challenges to address in increasing interoperability is compliance. Like, you know, again, technology, maybe it's a little bit easier to have bytes that move from one network to another, but doing that in a compliant manner or thinking about the travel rule, protecting privacy, but still meeting those obligations is an area that you were hinting at. Some technologies like decentralized identifiers are another one, zero knowledge proofs are another one where I'd say that's still pretty early days in the industry, but maybe just hone in on specific, less about Web 2 versus Web 3, but there's an obligation you have as a financial service provider that maybe is still a little bit rough to fulfill on-chain.
Brad makes a great point. We recently released a new token program at the primitive protocol layer called token extensions, which enable you to have KYC at the token issuance level. And so if you get allow listed for a particular token, you can then use that composably within the DeFi ecosystem while maintaining the regulatory compliance necessary.
Well, I'm glad we're talking about this because it's naturally where I wanted to go next, right? Like we could talk Web 2, Web 3, we could talk interoperability, we can talk composability, we can talk about the experience of the retail buyer, the investor, distribution. There's also this whole concept of permission versus permissionless, right? Centralized versus decentralized. And I think there's a lot to consider, especially on the regulatory and the compliance side of things, right? As much as the buyer may want to buy, the seller has some you know, rules they have to follow, right? And things that have been built up over years to protect investors for a million different reasons. One of the things that I think is that it's really hard, and I can't even imagine what it's like being in traditional finance, trying to understand how to access this kind of open network of potential technologies that you could use, not understanding or trying to understand all the different bells and whistles, right, of how they're built, who owns the smart contracts, what are the permissions around the tokens, who has access to those, where can it be used, right? What does the whitelist look like? Let's talk a little bit about maybe how important that piece of this puzzle is for growing the tokenized asset economy. And when we think about permission versus permissionless, right? Building in one route versus giving kind of choice and allowing people to toggle on and off like the experience they want to create. Let's dive into that a little bit.
Yeah, I mean, we should get more time because that topic on its own. I mean, anyways, that's a lot of where I spend my time, and I'm actually happy that this became a problem or a topic, because for us to get here is because people are trying out stuff, and they are now into this situation. Should I try Hyperledger? Should I try Stellar? Should I try Solana? Should I try that? And I think my kind of challenge is whenever an institution comes to us and say, we think we're going to start permission, or we think we're going to start on a side net. Well, in one hand, I said, like, I'm happy that you're trying it at all. So that's great, because ultimately you're trying blockchain. You're trying to, if it's going to work one day with the phone, right? So you're going to kind of learn how to use it. But the other challenge is, what is the feature or the pain point or the restriction that is driving that decision? And it's very hard to get a solid answer. I would say that to date, I basically haven't gotten a solid answer from central banks and private banks.
Why?
So sometimes it's regulatory driven. So I don't want to name regulators here, but there are some guidance in North Hemisphere that gave some ideas that financial institutions, especially the licensed banks, would only be able to try on the permissioned sphere. But then my point is, what feature isn't there on the permissionless side, right? And I could go on and on, but if you think about freezing, clawback, multi-signature, KYC, and I keep going on and on. Sanctions country. On Stellar, you can choose which nodes you trust, so you can just put some countries out of your trust quorum, and they say, oh, but they're going to get fees from, no, we don't pay fees to validators, so they don't make money. So I can't get to a list. And then finally, there was this idea that people don't want disclosure of transactions. And then I said, then why blockchain? Because honestly, if you want to just really not disclose anything, then we go back to centralized ledger. So I have a hard time, but instead of getting on the grumpy side, I think the happy side is, I'm happy you're trying. But the next step is narrow down the pain point or the exact feature where you think that those things don't work. And just to wrap up, I don't think it's versus, it's and. Because at this point, a lot of permission projects are great projects. I really, take my hat off to the Linux Foundation and everything they're doing. So they're educating a lot of players, and especially on the CBDC sides, it looked at the biggest jurisdictions are going on the hybrid model, wholesale CBDC being issued on a permission ledger and then figuring out the interoperability on the public side. So I think in general, it's good for the industry. But my challenge is, list down the features and then make an informed decision. Don't go with just like, oh, I'm afraid I'm going to go permission, right?
So I think inherent in your answer is there's a lot of nuance between, like, when people say permission versus permissionless, like, are we talking about permissionless versus permissioned validation? Are we talking about, like, permissioning as it relates to, like, asset access? Like what does that mean? So I think, like, at a high level, when people think about it, they think about, like, private permissioned enterprise chains versus public permissionless, L1s or L2s, for example. I think the important part to highlight is that people, barring regulatory considerations, want to build on, like, public infrastructure, because that means that there is an inherent, like, developer community and DeFi innovation and a user base and liquidity. And, like, that is the stuff that I think institutions and enterprises and others would want to tap into and ultimately benefit from. But just because you're building on a public permissionless chain doesn't mean, like, it's like a free-for-all, right? Like, there's, especially when we're talking about tokenization, from a certain sense, from a regulatory standpoint, it almost makes it easier, because most of the things that we're talking about in terms of tokenization are regulated financial assets that have laws, rules, and regulations that govern them off-chain. So by putting it on-chain doesn't mean you can obfuscate those things. And this technology, particularly at the token level, at the wallet level, already exists to enable one to reflect those compliance, transfer restrictions, and other things better than the traditional way of doing things. So it almost lets you, and going back to, like, the advantages, it actually lets you reflect and manage those things in a much more robust way. And so you can have permissioned assets and permissioned applications built on permissionless chains, and still allows you to kind of manage the laws, rules, and regulations that you need to off-chain. So all that's to say is I think it's a lot more nuanced than just, like, public versus permission, or public versus private, or permission versus permissionless. But those are kind of some of the things that I would highlight as it relates to, the capabilities today.
Maybe just following on that. So I guess this is a bit philosophical, a bit nuanced, but when you say building on permissionless chains, right? When we think about the traditional financial world, is it that if I'm sitting at a traditional financial institution, am I thinking to myself, okay, if I can't control it or I can't understand it at the deepest level, I feel like there's risk I'm taking?
Or if I'm building on a permissionless chain, is it, I don't really care about the risk I'm taking. I feel comfortable about it. I just don't know what's going to happen on the regulatory or compliance side of building in that manner if I trust a permissionless world. Anybody have a view on that?
I don't know if it's a one or the other. Again, I think it's back to the point of actually thinking more of your product than the infrastructure, right? Like I still struggle with that, initial statement you said, like I don't fully control or fully understand, because all our chains here, the public documentation goes all the way to the bit byte level. Like you know exactly how the protocol works. You just have to read it, and if it's not well written, let us know. But everything is you can understand exactly how the network is going to behave in all scenarios, right? We even outlined a scenario that never happened if the nodes disagree for whatever reason, and that's why we have trust quorums, where you actually shift to the nodes that you trust, and therefore there's a fork, which never happened. But it is even anticipated that scenario. So I don't know how much of disastrous scenarios could be out there. That said, if I was on the other side, and let me be fair, and I had the regulators breathing on my neck, and I'm a regulated bank, I would have a contingency plan. But that contingency plan is fairly easy to implement in any of our chains, because you host a node, you have the latest state of all the accounts. So if somebody magically turn it off, you just have the latest state of all accounts, right? And you just move it to a centralized database. So I don't know. I'm actually personally intrigued about what's the motivation of this full control, unless it's disclosure. That is my point. If it's non-disclosure, then I do understand that, and none of us, I think, can create secret blockchains on permissionless, right? But apart from that, I really don't, I can't wrap my head around that. I like it as a stepping stone. I really like the idea of a stepping stone. We build a product, we understand how it works, it looks fine, it feels fine. Now we're ready to tap the ecosystem and things like that.
I'll agree and slightly disagree. Like, as much as the documentation good, it's new technology. It's admittedly complicated and hard, and I agree, like, UNLs, validation, Byzantine fault tolerance, like, how much of that do you need to know, not need to know? It's new. So I actually analogize to, like, Nick's comment at the cloud. Like, everybody's on the cloud now, but when people, like, can I put my data on the cloud? Like, what happens if the cloud's not working? What do I do? And so I think that's just the natural fear. I think over time, the only driver that would remain, that's the concern, is more this regulatory, like, am I going to get slapped on the wrist if I do this? I think all those other things will just come from people trying and experimenting and learning. And I'd say, I mean, that's the experience we've had with our customers, where it's coming more from a lack of understanding. And as they get the understanding and they ask the use cases and the question, and like, so what are the actual problems you're trying to solve? And then, oh, there's a feature for that. Oh, you can have a trust line that kind of connects different accounts and controls who can hold the asset and whatnot. Okay, that makes sense. I can handle that. So I'd say it's mostly education from my experience and the customers we've talked with.
And just sorry, in that case, I don't think we disagree. Yes. And we're trying to disagree here. We try hard.
That was my best attempt.
Yeah, I know. Yeah, I saw your attempt there. But my point is that if it is a stepping stone on the learning cycle, I think it's actually delivering great value, right? And I think that's, and I understand it's not trivial technology. I'm just saying that if you decide to go that path, the argument shouldn't be the lack of understanding or control. It should be something else. But since it takes time to get there, then starting with something that you fully control is totally understandable. Probably a very reasonable decision.
So I'll add a comment that I don't think we've really touched on, which is demand-driven development. So we're talking a lot of like, R&D, folks are like kind of taking baby steps, they're dipping their toe in, they see the future, they want to be a part of it. Everyone will move much faster when the demand pull is there, right? And I think this is what, going back to the permission and permissionless point, why folks are starting to think about using, for example, token extensions on Solana, which are permissioned tokens on a permissionless network to access that 1.5 trillion of monthly stablecoin liquidity. And we've got now multiple on-chain treasuries with hundreds of millions of AUM. You've got BlackRock, you've got Ondo, you've got Franklin Templeton, each with, I think, roughly, 300 plus million of AUM. Add those together, you're now talking about $1 billion. And in the grand scheme of financial markets, that's, a drop in the bucket. But, when that billion becomes 10 billion, 50 billion, 100 billion, a trillion, which it all will, thanks to all the work that everyone here in the audience is doing, you're going to see folks moving much faster as the demand side grows for this type of use case.
I would just add to that to say, I think, I mean, that was like a microcosm of an example of demand pull, right? You saw all of this AUM on-chain, USDC, USDT, and that kind of, prompted a lot of these large name asset managers who, by the way, are more nimble and less, bound by regulatory kind of restrictions than banks are at this point. And so that kind of led them to deploy products and services on public permissionless chains geared toward that demand side. And it's great to kind of see that and excited to kind of see how that grows and develops. I think from a bank perspective, especially those that are based in the US, somebody put it like they're trying to innovate with both of their hands handcuffed behind their back because they can't hold crypto, they can't leverage public blockchain or public permissionless blockchains in the way that people think about it. And so I think in that sense, we've been working with them in the context of what we call subnets, which basically allows them to take this kind of baby step toward leveraging public blockchain infrastructure, but in a way that allows them to kind of control their end-to-end environment and still tap into the liquidity, the innovation, and all this, good stuff as it relates to public permissionless chains. I think there's certain jurisdictions more globally that are much more conducive, and so therefore we're seeing, banks kind of deploy on these public permissionless EVM chains. So it's definitely happening much more faster, I think, from the buy side, which is exciting to see. And I think, part of the reason why I left the banking world and kind of came here is because we could focus on those asset managers who I think at some point will pull in the banks to have to support those products and services if they kind of want to maintain their market share with the asset managers.
All right, our time's up, but I do want to ask one more question, and Brad, we'll start with you. Quick answer. Unfair question, but has to be asked. If the RWA market is, what is it right now, 1.5 billion or something like that, total on-chain, how big is it 12 months from now, and what's the unlock to get us there? We'll go down the row. 12
months now, I could see a 10x being pretty reasonable 12 months from now.
Includes stablecoins, obviously, yeah?
Sure. It'll make it easier for me to be accurate on that case. And I think the unlock is, regulatory clarity is the biggest unlock, I'd say, I think that we've talked about. But I'd say kind of maybe more in the next 12 months, it's probably just more of these use cases, institutions leaning in, which, we started, but really seeing these projects go live and people using them. So I think use case drives everything at the end of the day. Even regulatory clarity will come as a result of these use cases.
Rob?
I'll have to follow my colleague here. I thought about 10x on the RWA side. I don't think 10x on the stablecoin side, to be honest. I think that will not get there, unfortunately, in 12 months, but maybe grow 2x, 3x. And I agree. I think regulatory is the key bottleneck at this point, because what will drive the 10x become 100x is adoption from the institutions, right? Like the clients and the issuers. So hopefully those things walk together.
Good. Nick?
I'll mention a specific regulatory regime, which is MiCA, which goes live next month, and I think that will, add more clarity, at least in the European market, which can accelerate RWA adoption. I also like the 10x growth over the next 12 months, but I think, the beauty of compound growth is that, if you've got a couple 10x years in a row, right, you got 100x growth in 2 years, and I think that's the thing that we at Solana are really excited about.
And I actually think a lot of the growth will be in actually stable coins. Literally everyone and their mom is issuing stable coins or money market funds or yield-bearing stable coins, and there's a lot in the pipeline. And I think a lot of people are also trying to figure out how to integrate these things much more, especially on the tokenized money market fund side, into permissionless DeFi. And so I think as we see that cohort kind of grow out among, again, the more kind of crypto native community, I think it'll open people's eyes in terms of what are the possibilities when we issue products and services kind of further out the risk curve. So I do think the majority of the growth will come from that area.
Great. Thank you all for your time.
Thank you.
Thank you.